Welcome to the Finance Podcast. The topic of this episode, benefits of a B2B mortgage exchange, with Andrea Canonica from Credit Exchange.
It's a big pleasure for me actually to be here and talk about exchanges. I'm very passionate about exchanges. And if we close our eyes and we think about the word exchange, I'm sure every one of us see big server rooms, a lot of trading, microsecond transactions. But then it's also very interesting to remind that exchanges are actually very old. The first examples can be found in ancient civilizations back to the Romans or Greece and China as well. Of course, there people were not trading derivatives and futures and bonds. They were mainly trading food, a little bit of commodities, but the exchanges in itself, they go back really thousands of years. Then if we move further with the time, we have these very famous examples of exchanges in the Netherlands around the 17th century. Mainly famous for two big examples. One was this massive bubble, apologies, I'm not a biologist, but I think you say bulb of tulpin or tulpen, these flower roots. Mainly because of, I would say, market irrationality, they exploded in price. Apparently, these tulip flower were really trendy in 1630. And so the price of their roots exploded. And it grew up to, I think, around 10 times the average yearly salary for one bulb. Insane. And then, of course, like every excess, also that price collapsed. It was not a big damage for the economy, just a very important story to remember nowadays. Excesses are never good. Well, this is the first example of the Dutch exchange. The second important element relates to, I would say, the first IPOs. Also, thanks to the legal framework, it was possible to register a company with a limited liability. And in Amsterdam, the first IPOs took place from this East or West Indian company. They got private fund to expand the Dutch empire towards East and West. Then next big chapter was towards at the end of the 19th century or beginning of the 20th, with the New York Stock Exchange, this first trading in big rooms. Very interesting. I had the chance to visit the Madrid Stock Exchange, the old one. And as I understood from the guide, it sounds insane, but back in the days, beginning of the 20th century, trading sessions were organized in 15-minute blocks. The first 10 minutes were for trading, and after that, 5 minutes just to settle all the mess. So can you imagine, today you work 10 minutes, and then 5 minutes you clean your mess. Then another 10 minutes, and 5 minutes to clean the mess. It sounds incredible, but at the beginning of the 20th century, that was the best and most efficient way to trade. And then when we move towards the end of the 20th century, for sure, with the computing finance, the exchanges started exploding. And this brings me to the graph on this slide. When you look at exchanges, stock exchanges today, they are huge. You see New York Stock Exchange, Nasdaq, together they move on a yearly basis more than $35 trillion. Of course, then you have the Chinese, Euronext, London Stock Exchange, SIX, around 2 trillion turnover per year, which is huge if you compare it to the Swiss economy. If you take the GDP of a country, you see that for all mature countries, you have a kind of ratio of 1 to 2. So Swiss GDP around 800 billion, turnover at 2 trillion, more or less times 2. US around, I think around 20 trillion GDP. If you combine Nasdaq and New York Stock Exchange, also the double. UK, I think GDP would say around 4 or 5 billion. Here you see the size of the British financial sector, because there you see the turnover. It's towards 2 or 3 times the size of the country. So actually exchanges are huge today, extremely important. And they are so successful mainly for 5 common factors. The first, of course, they allow financial institutions to trade. Very important, I will come back later to this, independently from the client interface. But I will go back, as I said, later. Second element essential to determine the fair market price. Nobody wants to pay more and nobody wants to sell for less than the true value of whatever. And that's the beauty of any exchange. There you have the certainty out of all the market information and all the knowledge around. The price you pay is actually the fair price for this moment. Third element, enabling capital access. Of course, back to the Netherlands, they started financing shipping and missions towards East Indian or to the America with private capital. And today it's still the same. When a company needs to raise money for an expansion, the IPO is one of the most successful ways. The exchange provides those companies with the capital they need. Standardization, of course, is very important. A share is a share. Of course, Swiss law differs a little bit from America and UK, but at the end of the day, one share is more or less always the same thing, no matter where you buy it. Factor number 4, client protection, also extremely important. The role of the regulator is essential. Like the Netherlands bubble about this bulb of tulip, it's good if the excess only happens once and we don't repeat mistakes. That's why regulation is very, very important to foster confidence and ensure or try to maximize client protection. And then, of course, integration. Integration is always key for any economy. Now, if we take these factors now, success factors of exchanges, and then we look back to our little country, Switzerland, we see on one hand a very well-functioning stock market with SIX as a main exchange, and on the other hand, I would say a fairly traditional mortgage market. And with the traditional, I mean at the end, a little bit inefficient. Not because banks are inefficient, completely the other way around. It's mainly because of the client behavior that we see a huge inefficiency in the market. If you want to buy some Nestlé shares today, I'm sure nobody of you will try to take two phones and call at the same time, let's say UBS and ZKB, to try to negotiate the price of this Nestlé share. You don't do like this, no? What do? You choose your channel. Maybe some clients want to do it by their own. Maybe they go for a Swiss quote approach where they just select and buy. Other clients maybe need some advice. They have a trusted client advisor. They go to him. They let the advisor do his job. And at the end, once they are convinced, they just place the order. Yes, please buy me 100 shares of Nestlé. So in this market, on the right side, the client decides the channel. He does not need to compare various offers. And once he is convinced, he just places the order. There is once some analysis cost, like the risk awareness, the price, the advice, and the transaction cost only happens once. When we look now at the mortgage market, assuming all of you here have a mortgage, if you want a mortgage or if you need to extend it, what do you normally do? You go to your house bank, maybe to your second bank. Many people have 2 or 3. Then maybe to your insurance, maybe to your pension fund. And every time you bring all your documents, you need to disclose everything you do. So for you, it's a big cost, 4 or 5 times more or less the same meetings. For the counterparty, it's also a big investment because every bank you go to, every insurance and your pension fund, they will get your dossier, they will check all your documents, they will check your credit worthiness, they will make their analysis. But out of 5 institutions, only 1 will get your mortgage. So the client behavior, for good reason, generates a lot of inefficiencies in the market. And exactly this efficiency can be solved with a mortgage exchange. If we look back to the stock exchange, how does an exchange work? Well, you have pre-trade activity, at trade, and post-trade activities. Pre-trade, it's everything which relates to data, indices, SMI, bond indices, S&P 500, or sector indices, and so on. So preparing a benchmark for your investment. And then, of course, based on your portfolio, also your risk management approach. Do you want more equity, currency diversification, and so on? This is everything which relates to the pre-trade. At trade is exactly what SIX does, matching demand with supply. There is an order book, listing all the buy order, all the sell orders with their limits, market prices, and so on. And every time there is a match, they do the transaction. And very important, the topic of the client interface. If I buy now Nestlé shares through a cantonal bank, I will not be forwarded to the seller of those shares. The bank connects to SIX. They buy my 100 shares through SIX. Another bank will sell them. I don't need, as an end client, to open any account to at the seller. I can stay with my bank where I was, and I am still happy, and that's it. Okay? So in the stock market, the client interface always remains with the distribution. And this is an essential factor, I believe, also for the exchange for mortgages. Just to close the slide, post-trade activities, actually everything which relates to clearing, settlement, so everything which needs to happen with a cash flow. One party get the money, the other one get the share. And then corporate actions. If you buy shares, there is also a life cycle. From time to time you get dividends, maybe there is a corporate action, maybe there is a split. Instead of one share of 10 francs, you get 2 shares of 5 francs, and so on. And this processing is actually the corporate actions. Now, if we try to imagine an exchange for mortgages, actually everything can work exactly in the same way. Except that now, instead of data and indices, we have the main refinancing rates and S&B policy rates that we can observe in the market. So the S&B rate at 1.5 at the moment, and refinancing mainly is swap rates. Looking at risk management, now it's about a credit model. Banks tends to evaluate mortgages more or less in the same way, but there are other actors like pension funds, insurances, or overall funds that can assess the credit worthiness in a slightly different way. At trade activities, also here, exactly the same. Based on risk-adjusted pricing, the mortgage exchange does nothing else than matching demand with supply. There is an order book as well with all the transactions that took place. And also here, very important, the client interface needs to remain with the distributor. Like for shares, if I decide to opt for a partner, I'm very happy to keep the relationship with him no matter where the money is coming from. This is a very important element. And also interesting, post-trade, what is the equivalent of the clearing? Well, it's actually the management of securities. With a mortgage, you always have a debenture, like a Schuldbrief in German. You need to manage and transfer those securities to give the collateral to the institution which gave you the loan. Everything that relates to disbursement of the interest rate and, disbursement of the mortgage in itself and then collection of the interest rate is exactly what the settlement does for shares. And then instead of having corporate actions, you have mutation. Maybe the client needs more money. Maybe he wants to terminate the mortgage early. Maybe there is a divorce and he needs to maybe sell the house, whatever happens. So you have the one-to-one pendant between stock and mortgages with essentially the same activities. Now, out of this concept, which benefits can made available? For banks, if you look in terms of distribution perspective, for sure, normally you tend to use your balance sheets to finance your clients. This is what banks do all the time, and this makes sense. But from time to time, every bank ends up in a situation where maybe they have a lot of clients and maybe some limitation in the balance sheet. And then it's always hard to tell a client, no, we cannot finance you. And it's always very hard to increase the interest rates for all your distribution network if you are struggling a little bit with your refinancing possibility. So if you have the chance, like for stocks, to keep the client relationship, sell the mortgage, and then just put it through an exchange to get the refinancing somewhere else, well, you can keep the client relationship exclusively. So by the expiry of the mortgage or by any life cycle event, you will be still there as primary contact person for the client. So if all in a sudden you start splitting up your financing possibilities or your balance sheet from your distribution, you can use the exchange like a market expansion strategy. You can start either selling more through your distribution network or to finance more, if your distribution network is maybe limited on a geographical level. From the perspective of the treasurer, now finally he gets the freedom to start placing the liquidity exactly how he wants. Of course, a big bank can diversify by its own, but if we take the example of a regional bank, just from a diversification perspective or from a speed perspective, it can be very challenging to place the liquidity in the way you want, with the tenors you want, the risk you want. You are actually depending on which clients come to your distribution network. With an exchange, all in a sudden, you can start financing the clients of someone else if they match your risk or liquidity profile better. And from the perspective of the CEO of the executive board, if you start using a piece of your balance sheet to dynamically trade mortgages, well, all in a sudden you can increase revenues because you make more money on the distribution, you can allocate your capital better, you can match your maturities better. You can also reduce the cost. Because like in the past, the trading was done, with 1,000 people, now it's mainly done through machines. So there is a cost element, and if you increase the revenues and decrease costs, well, you end up with a better cost-income ratio. When we take an insurance now, the same concept can generate similar but also different benefits. Of course, in terms of distribution, the most important thing is to keep the client relationship, not having to forward the client to someone else. If the clients stick with you, the big advantage is that you can increase the customer lifetime value. Insurances are extremely good in maximizing this. They know exactly if you just have a car insurance, most likely, in 3 years they will lose you. But if you have a car insurance plus a life insurance, you will stick around for 7. And if you can get also a mortgage in the package, then the client will be with you more or less forever. And by increasing this customer lifetime value, also the insurance or the distribution especially can profit because they will keep the client exclusively for them. From other perspective, well, I would say in terms of asset management, you can really diversify the risk as you want. Normally, the asset management of an insurance company, they tend to prefer low risk profiles, not really edge financing where the client is really at the limit, but more relaxed cherry picking AAA. If you don't need to finance all the clients coming through your distribution, but you can simply pick whatever comes to the exchange, then you can exactly allocate your money based on your risk profile without any need just to keep your sales guys happy. An exchange automates the decision process, simplifies a lot, and some could argue, yeah, but then the job of the classical credit officer, what will he do? Well, actually, by standardizing and automating all the simple transactions, all in a sudden, a credit officer will have definitely more time to look after more complex transactions. We see this with our daily business. All in a sudden, you don't need anymore to check the income statement and the loan certificate of a normal employee just to give him a little discount on his own mortgage. This can easily be automated, and then the time you get out of this automation can be really invested in much more complex financing, exactly those mortgages which are not really suitable for an automated platforms, where there is an added value in the credit analysis, and also the size of the mortgage is definitely on another level. When we take then the perspective of the executive board of an insurance, well, all in a sudden your brand gets strengthened. In the sense, if you can keep your client exclusively with you, and on the other hand, you can allocate your assets independently from your distribution, then your brand will just profit a lot. Last but not least, in case some of you is working for a pension fund, the same concept also generates some benefits for the pension fund in terms mainly of market access. Especially for little pension funds, it's always a hard question, how can I enter the mortgage market? How can I start financing mortgages? Well, the option of setting up a distribution channel, hiring a client advisor and start selling your own mortgages, it's definitely too costly for the return of a mortgage. Of course, you can work in partnership with many companies, but the big advantage of an exchange is that all in a sudden, you get the full market exposure. You can just parameterize, like in Bloomberg, your bond portfolio, decide what you want, and then step by step, you will start financing. And then because you are investing in single mortgages, you can also benefit from the booking at nominal value. If you invest in a fund, of course, you are depending on the market circumstances. When interest rates goes up, then the value of a fixed income instrument decreases. Of course, it's just short term. If you keep until maturity and nothing defaults, you will be repaid at 100%. But short term, for a pension fund, can be a little bit of a problem, especially when shares go down, bond goes down, and mortgages as well. Then on a short term, you really have a very negative performance. At least if a portion of the portfolio is directly invested into mortgages, well, this piece will stay booked at 100%. You have zero volatility and 1-2% excess return, depending on your benchmark. Now, good for financial institutions, but why it is also very good for the client? Well, for the end client, the first major advantage is the convenience. Like for a stock exchange, you choose your partner. It doesn't matter if your preferred advisor is a big international bank or a little local one. You can buy the shares you want wherever you want. And in the same way with a mortgage exchange, the client can just choose his preferred partner, the advisor he trusts, and get the mortgage from himself, from this partner, independently from the financing capabilities of this partner. Second big advantage, the market price. Again, no need anymore to call and speak with various institutions and collect multiple offers. There is a fair market price, it's only one, and you pay exactly what is fair to pay for. Liquidity as well. Thanks to the availability of various lenders on the supply side. Maybe as a client, I'm not that good for my preferred partner, but maybe my risk profile matches exactly what someone else is looking for. So thanks to this risk model plurality and this enhanced financing possibility through the exchange, also the client with higher liquidity can definitely get a better offer. And then speed. Like the trading for shares, evolved from taking maybe days, then hours, then minutes, and now seconds, microseconds, or nanoseconds, whatever, also for mortgages. The speed increases a lot if you can process mortgages through an exchange. And this is also very good for the client. If you need to wait many days or weeks before you get your final mortgage contract, well, as long as it works, it's okay, but there is still an element of insecurity. If you can shrink these many days into few hours, well, it's much, much better. Now, just to show you some graph, exactly about this conclusion time. Within our company, we have a couple of data scientists. That's why this graph could look very complex, but in reality, it's very simple. It's just a kind of statistical visualization of the distribution. This graph shows you essentially for a kind of traditional market, the normal conclusion, when you go to a bank or an insurance, you see the time needed between the offer and the final signed contract. And you always have the minimum. Then between this bottom line and the first long line, you have like 25% of the cases. Then you have another line where you have 50% of the cases between minimum and here, hence 25 between these two. Then you have another line for the 75% of the cases, and then the max. And so out of approximately 2,000 transactions, we could observe this situation. If you close your mortgage with a bank or an insurance in a traditional way, normally, or the majority of the cases, you need to wait a couple of weeks before getting a fully signed contract. Could be an issue for some, maybe not such a big issue for others, but as of a fact, it takes quite a lot of time to get the final legal security of getting the mortgages. Because at the end, no matters what the client advisor tells me, what matters is at the end written in a contract. We had some outliers going even above 20 days required to get the final contract, but these are actually more outliers. The majority are, let's say, between 7 and 14 days. Now, what we can observe on our platform is that this time massively decrease. Okay, we have some partners taking up to 5 days between the offer and the final signed contract, but we have other examples where actually within less than 10 minutes, the client went from the offer to the final signed contracts. And this, at the end, for the end client can only be an advantage, to have the full security that the mortgage is granted within minutes instead of weeks. So from what we can measure, from 5 to 10 times faster. And then also the spread you can see between offers. Here we had around or slightly more than 500 observations. We actually checked the difference in the traditional market between the best offer and other offers. And you see sometimes you have one or two institutions offering exactly the same rate. You have the majority of the institution in a kind of range between 0 and 20 basis points. And in some cases, the offers diverge from more than 0.4%, huge spread. And of course, with such a huge difference, I really understand every client should really look for 3, 4, 5 offers, just to be sure that he's more on this side than the other one. Now, of course, if you have an exchange, then there is just one market price. There is not a second best offer or third best or whatever. So, of course, you only have one price, and this is the cheapest price you could get. So, out of all these slides, if you can remember 2 things, these are the things you should remember. So, if financial institution could transact all mortgages through an exchange, they will profit so much in terms of costs, in terms of revenues, both for distribution from an asset and liability perspective, and then depending on the institution types, also in terms of customer lifetime value. This for the financial sector. For the end client, the main advantages of a mortgage exchange relates to the capital access, the fair market price, and the convenience overall for mortgages. That's it. 2 main takeaways. Hope they will stick with you for today, maybe also tomorrow, maybe also later on. And of course, if you would like to understand more about credit exchange, what we do, just feel free to contact me. I suppose these slides will be made available to everyone. Otherwise, we have a little stand at the fair. I'm very thankful to you for your presence here. And, well, if there are questions, just shout. Otherwise, I understand. Last presentation of the second day. Oh, we are all tired. Then I thank you even more. And I wish you goodbye. Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.